If we were to tell the story that I know, I worry that people would march upon the Eccles building and try to burn it down.
We've got Garrett Baldwin today. He's an expert and analyst in finance and economics, both micro and macro, and the author of the enormously popular Substack, Me and the Money Printer. Garrett Baldwin, welcome to the show.
Thanks for having me. Great to see you again. I know it's been a while. It was, last time we got together was in Nashville, so great to be with you today.
Good to see you again. And look, I have to say, you're talking to someone who is a philosopher by training and basically just a rogue intellectual. But let's start with something very simple, probably to you, but maybe not to some of our listeners. Let's riff on the title of your Substack, Me and the Money Printer. What's that all about? And if there's anything that you want to sort of leave or impart on people like me with a beginner's mind about stuff like money printing, what would it be?
Well, just so that you know, one of the key things is that there are two parts to it, right? There's me, and that's my life. I talk about my daughter and her soccer team quite a bit, but then there's this concept of the money printer. And for the better part of 17 years, I went on kind of an academic odyssey. I went to 3 different graduate schools and then did some work at a 4th school, trying to actually understand how this financial system actually operates. You watch CNBC, you watch all of these different publications. They talk about price to earnings. They talk about EBITDA. They talk about all of these other concepts. But then in 2018, when I was doing one last graduate program and read a book by a gentleman by the name of Michael Howe at Cross Border Capital, things really clicked. And it was the idea that money is not created the way that people traditionally think it is. The banking system today is not operating the way that it did pre-2008. Today, the banking system is largely driven by what is known as the shadow banking system through treasury work and a lot of continued types of programs that are designed to increase the term liquidity. And liquidity is not just money. It's the idea that you're going to have money in the future. What that effectively means is if you have money coming in on a day-to-day basis, you're in good shape. You feel liquid. And then all of a sudden, you lose some hours or you lose your job or your wife loses her work. And now you don't have that level of confidence anymore. The markets work on that at a significant scale. We're not talking about your day-to-day paycheck. You're talking about the entire financial system and the core need of continuous liquidity in the financial markets to maintain the elevation that we see in equities. So it started with a focus on how momentum trading worked. It started with understanding insider buying, but really the key thing that put it together for me was the work that I did with Forrest Reinhardt at Harvard, and then the reading that I had done with Michael Howe in explaining that liquidity is needed to keep the system going. Debt is exponential, but liquidity moves in waves. And as a result of that, we have these short-term financial events that transpire. We had a big downturn in the markets in August 2024 because of Japan. We had a huge downturn in April of 2025, another big downturn. Had nothing to do with fundamentals. It had to do with a lack of collateral and quality collateral to refinance existing debt in the financial system. And that is very foreign to people. It was very foreign to me 8 years ago. But I have found consistently that the way that momentum works and momentum trading is directly a reflection of liquidity in the markets. And I simply want to try to train people and educate them on how to understand these waves, but then also to protect themselves. I'm not a person who's making stock recommendations. I'm trying to get out in front of potential short-term crises because a lot of people will naturally sell when markets are really at their worst. But reality is there are these policy clues that will happen. The central bank will create a new tool that is money printing, even though it is a different form of capital expansion. And insiders who are executives at companies, and we'll talk about this more, have been the biggest signal for buying the dip and looking for markets to return to all-time highs.
I hesitate to launch into this, but I have a feeling there's a connection here. You use the term which has become more and more commonplace, that we've seen
Mhm,
our economy become financialized.
mhm.
And financialization is this process that our economy's undergone that is essentially that has to do with what you just talked about, but for someone like me who doesn't
Mhm.
understand the complexities of how the money
Sure.
printer works, how the financial institutions work, and shadow banking in particular, what does this financialization mean, and especially to ordinary investors and savers?
So you have a dollar in your pocket. And if you look at the dollar itself, it says that it is a tool to effectively pay off all debts, public and private. That's what a dollar is. And what has happened, and this is largely going back to 1971 when we came off the gold standard, the United States economy has moved from a manufacturing economy to what is known as a financialized one. And the very simple way of putting this is financialization is at its core a shift of an economy built on production to one built on what are known as financial claims. So basically, the entire economy profits from less building things and more from leverage in a financial system, asset inflations, fee extraction, and basically financial engineering. And what happens is people who own homes aren't viewing them as a place to live. They become speculative assets. College becomes a lending product. Healthcare becomes a billing product. Corporations basically will favor buying back stock over actually investing in it. So it's not an ideological debate, it's a structural issue. And it dates back to the fact that our currency, the US dollar, has devolved into an asset that is not backed by anything. And resultantly, it created what is known as a production curse in the United States over the last 50 to 60 years. And it's gotten worse with time. Effectively, what has happened is the strong dollar is a massive, massive, massive benefit to consumers, but it really drastically hurts our production. And our production economy has fallen, I believe, from about 25% to 11%, while financials, real estate, and insurance have jumped to 25% of the economy. And once you tie your economic growth cycle to credit creation and asset prices, that financial layer is what becomes the core driver of the economy. And that is the environment that we live in right now.
Is this sort of what we intuitively think of as the kicking the can kind of stuff from the Fed and from the banks, which, it seems like whatever one thinks about the Trump administration, they're trying to reverse that in a sense.
Yes.
It seems like they're not only trying to bring down the interest rates, but also are somewhat more comfortable with inflation as a means of addressing, for example, how much the Treasury, the federal government, owes
Hmm.
and servicing that debt and so on. We think of that intuitively as, all of this money floating around in the system is what drives inflation. It's a monetary phenomenon.
Hmm.
Is that still accurate to some degree, notwithstanding the complexities that you point out? And is there a way to reverse it that's not just filled with pain?
Inflation is always a monetary phenomenon, and it's evident when you look at go back and look at the 1978 CPI numbers and just track everything in this economy dating back since that point. Couple of really key parts about this. So, what is deflationary in the economy? Technology. Technology drives, I believe, the average television from 1978. The value of that technology is down 99.99%. So all of these deflationary technology gains that we have offset the things that actually matter. So electricity costs, housing, college, food, all of those things are above CPI for the last 3 decades. And then once we added on these layers of financialization, we created a lot of different tools in place that led to massive rises in food costs 2008. And we'll get into something about Bitcoin that I recently wrote that I think is a little on the tier on what I believe Bitcoin actually is. But the core thing here is that the cost of things continue to move higher. And the entire process of the economy, remember, we're $38 trillion in the hole. We are continuously looking for ways to get someone to buy our debt. And they are doing it through fiat. They've done it through the Genius Act with the short-term moves on the stable coins. They have done this with the basis trade. And the basis trade, if you don't know what that is, it's basically a hedge fund buys a lot of treasury bills or 10-year bonds. They go to what's known as the repo market, which is the overnight lending market. They use those treasuries as collateral. They borrow more money and basically don't have to pay any interest on it and buy more treasury bills. And they do this process 6 or 7 times. And then they do the same thing with equities. So they'll buy FANG stocks. So you can turn a $100 million position into a leveraged position of about $2.5 billion. You have a massive amount of treasury bills. But what happens is when the markets start to have these feelings that there isn't enough liquidity, that's where those things unwind. And it was very interesting back in April. Janet Yellen was giving an interview to the Australian Financial Review. And somebody said, what was this all about when the markets really tanked around April 7th, April 8th? And she said, we had a lot of leveraged hedge funds that were selling treasury bills and and bonds. And the journalist did not ask her, why do they have it in the first place? Because that is the safest asset in all of finance, the 10-year bond. That is considered the risk-free rate. So these funds have been, in essence, holding our debt, levering it up, looking for smaller percentage gains, looking for 15% a year. But when that unwinds, it unwinds violently. And they are continuously looking for new ways to do this. And one of the other things that they have done, and this is very important, in 2017, the Treasury Department had to finance the deficit from the Tax Cuts and Jobs Act. We did this with only 11% of our debt was T-bills, things that are under 12 months, right? So they expire in 12 months. We never repay any of the debt. People just roll that debt over. That has exploded from 11% to about 22%. So we are financing our debt with these very short-term treasury bills. And those treasury bills are extremely liquid assets that can be borrowed against. And that is how you end up with lots of leverage in the financial system. And then ultimately, valuations don't matter. It's just people chasing valuations higher. And when it unwinds violently, and it unwinded again in April 2025. August 2024, some great companies like NVIDIA fell 33% in 2.5 weeks. Nothing changed about the fundamentals of the company. It was just that the financial markets themselves could not bear the strain. And that's why the the Fed is now buying $40 billion a month in short-term T-bills, why they're doing so much repo work. They're trying to keep this thing in order. And it seems very, very clear that this is a preview of what the breakdown is going to look like in the future.
Is there a sense in which all of this, it sounds to me like a weird financial shell game for arbitrageurs at some level that's way beyond my pay grade, right? But
Yep.
what this does is when you can no longer play the game, something happens. And as you said, the fallout is violent. It cascades through the rest of the economy, including all of the companies that you've got in your stock portfolio.
Right.
And, Main Street loses out and Wall Street starts looking around to be bailed out.
Right.
And it strikes me then, based on this description, that there's kind of an ongoing bailout system with these repo markets and shadow banking and so on, that this is kind of like in perpetuity now, this kicking of the can. And I speak in metaphors because I have trouble really appreciating the dynamics of it. But is that more or less what happens? And is there a catastrophic scenario in which all of this unwinds and the entire economy goes tits up, 1930s style?
So I would say this, it's funny, if you look at, I was looking at a chart the other day of the Venezuelan stock market, and it's just an exponential move higher, right? Their currency completely goes. And we've had 2 examples recently where inflation was elevated in a foreign country, and they stepped in and they still did a form of quantitative easing or stimulus. It's happening right now with Japan, and it happened in 2022 during the gilt crisis, which was a catastrophic pension crisis in England
Britain,
that
UK. Yeah.
which easily could have caused a massive downturn in the U.S. markets, because the way that markets work, there's a paradoxical event that transpires every time that we engage in quantitative easing, and we buy bonds, we inject money into the markets. That's one of the tools the Fed will use. When that happens, foreign money comes here to the United States. And about 19% of GDP, I believe, or it's a massive figure, is foreign capital that is chasing returns here in this market. And it's a result of our financialization of the economy because, once again, when you print that much money and you have that much money chasing fewer, scarcer assets, that leads
Mhm.
to price appreciation. So there's two scenarios, and there's two scenarios that we'll touch on, and then we'll talk about the perpetual bailout system that is very clearly part of the financial system post 2008. The first event would be something happens that foreign investors lose trust in the United States. And what that would do is, and I just want to point this out, back in 1997, about 5% of money in the stock market was passive investing. So ETFs and mutual funds, money that they don't care what the performance is. They're collecting 2% ratios. The money managers aren't focusing on performance. They're just trying to replicate an index. At the time, leveraged funds were about 15%, and people like Warren Buffett and Michael Burry, who try to buy for $1 and sell for 2 because they believe in the fundamentals of the market, they were about 80% of the flows. And this is according to Cross-Border Capital. That passive flow number is over 50% now. So that passive flow creates a floor for valuations in the equity market. Again, they're not worried. These money managers have an incentive in this system to just build a basket of stocks, collect 2 to 3% a year in an expense, or maybe even 0.3% in an expense ratio, and then they can lend the stocks out to short sellers if they want. So there's no incentive for people to actually actively manage a portfolio. The leverage funds, the ones that are buying the stock, as I described to you, how that leverage strategy, that's about 35% of the market now. And the value investor is only about 15%. So that incentive has changed, that setup has changed the markets fundamentally since 2008. Now, why does it matter? If that foreign flow comes out of the US market, if money leaves the US, that can lead to the leverage funds having to sell. And then the passive funds are not going to turn back around and buy assets at the way that they have. So it creates a cascading effect. That's scenario one. And I think you have to keep in mind that most crises in the financial markets will originate in other financial markets. They will originate in Europe like they did in 2011. We had China in 2016. We had to open up swap lines in 2008 and 2020. And a lot of these crises originate in the unregulated shadow banking hedge funds, money market funds, private credit funds that a lot of people don't know exist. The second scenario is actually the more terrifying one, and that is nobody wants short-term T-bills from the United States anymore. Or short-term lending, 1-year lending goes to 6, 7, 8, 9% because people are concerned about valuations. They're just concerned about whether or not the United States is going to be able to pay. They are going to be able to pay. I mean, there is a money printing mechanism here in the United States. We have a printing press. They're technically not going to default. The question, unfortunately, is how bad and how directional can our debt go over the next, say, 5 to 10 years if our interest rates are elevated and we're paying $1.5 to $2 trillion a year in interest, which does not go into the economy. It goes into the hands of those leveraged funds and other people in the shadow market. Now, as to answer your question about the recovery, we have had multiple what are known as K-shaped recoveries in the markets in the last 17 years. And what that means is the central bank steps in, or the Treasury Department issues more Treasury bills at the front end of the curve, which provides more leverage into the financial system. I know this is complex, but I'm operating a little bit on autopilot for it because it's very difficult to really compartmentalize down to like a eighth, ninth grade financial, class.
And when you say stuff like leverage
Yeah.
for the uninitiated, that just means debt. Somebody's holding
Yes.
someone else's debt.
Margin, yes. The ability to
And
borrow money so that they can buy more stocks. And that's how this thing operates. And the thing that I will say is 2017, 2018, maybe I understood 90% of this. I would comfortably say I'm at like 98 right now, but that last 2% is like the distance from here to the sun. So it's still quite complex. And I think one of the key things to keep in mind here is the way that it works is what these K-shaped recoveries look like, where the top shareholders in the markets are effectively bailed out while everybody else is stuck running in neutral. It's something called the Cantillon effect. And the Cantillon
I was
effect
just
was
about to
something,
ask you about that.
yeah, this was discovered, by by a Irish economist who recognized that people who were closest to the origination of money, particularly metal currencies, were the ones who benefited the most because they would get the currency knowing that it had been debased, that they had taken a certain percentage out of the metal content, the gold, the silver, but they could spend it freely without the knowledge of what was happening downstream by other people. Well, in this market, it's a different form of Cantillon effect. It's who's closest to the origination point of capital. And about and all the private credit funds and the money market funds and the hedge funds, they don't really get impacted by the inflation that's created by new money. It ends up at the bottom of the supply chain where the consumer is, and
Ex-
typically that new money becomes a new form of debt for that consumer. So it originates as effectively cash for the hedge funds, the stablecoin issuers, the sovereign funds. But when you and that's in the treasury bills and their ability to lever these things up. But all the way at the end, where you and I are going out and getting a mortgage, going out and taking on credit card debt, it really ends up in an interest payment for all of us. And that's the key differentiator in this economy. And there's really no way to really alter that. You can't tax it because it'll knock out all of the incentives. It just seems to be the function of the way that the market operates. And the question is, how do you get closest to the money printer, or how do you focus on, I talked about extraction earlier, of being able to generate as much income as you possibly can from assets that a lot of these investment groups are tied to.
Forgive this brief interruption, but I suspect you're here because you're disillusioned with legacy politics. If you're a creative, a builder, or an innovator, you might be ready to win funding. Through Human Respect Labs, you can get up to $30,000 to fund your next creative project. But not just any project. We're looking for 6 kinds of builders: video storytellers, community builders, writers, entrepreneurs, strategists, and innovators, any of which should be dedicated to human liberation. That means making government obsolete. Why? We know too much energy goes into politics, but not enough goes into real solutions. So if you're a freedom lover and you have a project idea that promotes peace, autonomy, and voluntary collaboration, we want to hear from you. Apply now at humanrespectlabs.org. That's humanrespectlabs.org. Criticize by creating. It seems to me that you've painted a picture of something like tines of the devil's fork, let's call it.
Right.
And one of those tines is, maybe I misinterpreted you, but sort of like a drying up of liquidity in the system after everything cascades through, and there's a catastrophe in that respect. So the over leverage, if that's the right term, creates conditions where the liquidity dries up to just like slam the brakes on the economy from that end. The other is, of course, the Cantillon effect is a happy byproduct for the masters in the universe, right? But it is kind of a rigged game. It is kind of a rigged game, and in the sense that when it gets down to us and we're trying to buy eggs, we're not paying $3, we're paying $12. That looks like it could be the other fork, where we're sort of staring down inflation in perpetuity, and it might not be to the level of a Venezuela or a Zimbabwe, but it's going to be bad enough and we're going to feel it. So is there any way to avoid one or both of these scenarios? Or better put, you talk about the U.S., we might hit a wall. And I think you used the term hit a wall in 26 or 27. Would these be the circumstances for that wall or something else?
No, I mean, these would be the circumstances for that wall. And according to, the work of Posner and Howe and, the macro forces and macro edges on Substack, they focus heavily on these waves of capital in the system. And you can see clearly in the chart where liquidity and capital and the challenges of refinancing created these massive headaches in the financial systems: 2008, 2011, 2015, 18, 20, and 22. And typically the big moves are 4 to 6 years. So the way that it's been defined right now is that we are at the top of our liquidity chain right now. China is at the bottom of theirs, which is actually interesting because they're engaging in a lot of stimulus right now. That's going to have an impact on commodity prices because China is at its core a manufacturing economy, and we're a financialized one. So we print money and our banks go up in equity prices. They print money and their manufacturers do a lot better. So when we look at this and you're kind of at this peak, you have record treasury rollover at higher rates, particularly the short term debt. And that's why they want to get interest rates down. But the threat of inflation is there. And I said a couple of years ago, there were people advocating for this. Paul Krugman, a couple other folks suggesting, let's just cap CPI at 3% and try to get through this. That creates a bad precedent. Now, the funny thing about the Fed's target rate of 2% is that it's completely made up. And they did it in the mid 1990s, and then they never told anybody for 15 years that this thing existed, which once again became something that was very beneficial for the people who were closest to the money who had knowledge of that. But you
This
have
was
an
Greenspan
acceleration
times, I guess,
yeah,
right?
yeah, yeah. And you have an acceleration in entitlements, and you have to really pay attention to foreign appetite for US debt. China's not buying. Japan's probably not going to be buying because their
Well,
interest
they got
rates are
their own
going up for the
problems.
first time in 30 years. Yeah. Yeah,
Yeah.
first time in
Yeah.
30 years that they're really raising rates. So you add in a shadow banking that requires constant collateral expansion, and you get a moment where the math stops cooperating. And it doesn't mean collapse, it just means regime shift and forced discipline. And then basically they come up with different ways to refinance, they come up with different ways to financialize or monetize that debt. And I would argue that, it's not going to be very popular, but I would say in 27 or 28, if we see a situation where the Fed has to act as the lender of last resort, that balance sheet is going up again. And it's already at 6.7 trillion. It was at 9 trillion 2 years ago, 3 years ago. We could see this over $10 trillion. And that's exactly the type of tools that Japan has used for decades in order to manage their debt and try to keep their interest rates lower.
You said a while ago that you feel like you've gotten closer to appreciating the nature and dynamics of the system. I think something along the lines that you feel like you're at 98%, but that last 2% is
Yep.
the distance between here and the sun. It's a vast gulf. And I think, one of the lessons, and I'm an old, I was influenced by the Austrian economists, which
Sure.
you may or may not be, but one of the lessons I feel like of Austrian economics is that these systems are complex,
Mhm.
and complex systems tend not to be able to be fixed or run or regulated in a manner that we would think, because there are just too many causal forces there that are beyond our ken as individuals. Economies are massively complex systems. Now
Yeah.
that's an important lesson, and I think that's goes into part of the 2% piece there,
Yep.
that you may never be able to bridge that gulf, and that's okay. But what's also interesting about that is when you turn it around for the average consumer or the average investor, in either case, you might be a consumer of business to business, something like that. Like, I want to get an input to my business, so you're
Mhm.
using the price system and so on. But or as an investor, as an individual investor, I'm putting money into an ETF where these guys, as you say, are basically indexing it broadly. They're not looking at the value of individual companies and putting them into your portfolio. And what it looks like to me, that we've got a situation in where it's almost so distorted from the standpoint of price and value
Mhm.
that nobody can be a decent investor anymore when looking at individual companies, because prices are just so foobar and distorted. Is that true? And what does someone like me here
Yeah.
on Main Street do about that?
Well, you're dead right because again, a lot of people, and I think the news is financial news is a big propagator of this, is that no one takes the time to explain, how foreign euro dollar markets work, right? Like the entire concept of the money that is outside the US system that needs to be perpetually there so that European banks don't blow up. The relationship between China and the United States and the fact that China uses the dollar at an extreme level because of exporting or understanding, how things really operate. And today, if you turn on CNBC and you turn on media, and this is how the journalists are trained. I'm a Medill trained journalist, and this is what I thought. I thought that earnings drove markets, and we've seen the last couple of years. It's maybe 25% of the appreciation of the equity market since 2022 have been driven by earnings. Everything else is valuation expansion. Everything else is people willing to pay an extra dollar for earnings because they're speculating to that point up. And you have all of these different things that people focus on. There lots of conversations about GDP or the consumer price index or the soft landing narrative. And really, that's not what's doing it. It's the Treasury issuing money, and nobody explains Treasury auctions. Nobody explains repo markets. You hear it every now and then. We literally focus on whether or not the Fed's going to cut rates every single day, and the reality is that the Fed's EFFR, that doesn't even matter anymore. It's the secure overnight funding rate of the repo market that's really driving everything, and how banks use the standing repo facility, which nobody really knows existed, but it's something the Fed created to ensure that banks could go at any time to get money that they needed for operations. And these are the things that I think are very challenging to people because they haven't heard about them, or what's really more intense is you have to unlearn them. And, I have an MBA in finance. I had to reject a lot of what I learned because, again, what I'm seeing is a completely different system than what I was educated upon, because teachers become professors. They focus on the same thing. And for me, you mentioned the Austrian economics. I agree with you, but here's the issue. The issue is that we operate on a Keynesian economy. We operate on a Keynesian money refinancing system. And what would it look like to try to blow that up? And I don't know what the answer would even be, but here's the problem.
Well, that
If you
takes
blow
away
it
my
up,
future question for you.
if you try to blow it up and people have, no ability to really comprehend it or understand it, they're going to blame the person who blew it up, trying
They're
to
going to blame
explain, hey, this is,
capitalism.
oh, they're definitely going to blame capitalism. But
Yeah.
I've said multiple times that I think capitalism died in 2008.
Yeah.
I don't see it anywhere, and it's funny to listen to, but we have a central bank that gets together every 6 months, every 6 weeks, and they try to plan the economy around labor markets and inflation rates using one tool that is antiquated. And you can't tell me that there isn't a data set out there that would better predict views on inflation than 12 people in a room. It doesn't add up. Then you have a system that has really built up, and you're seeing it. And I write about this at my other Substack. It's called Postcards from the Edge of the World. But it's this economy that is really built around extraction fees. And the idea that, you know, Amazon is a feudal, it legitimately looks like ninth century France, the way that they have built their business. It is hyper feudalistic, where they extract fees. They built the infrastructure for all. They just did this. They had people who helped design their API. People built the roads for them, gave them all the tools, helped Amazon build all these tools up. And then they said, well, we're going to start charging you $1,400 a year just to be a part of this. And that was the model. It was, you build the roads, you build the dependency, and then you hit them with the tax. So I don't consider that anything. So, I always, people say, well, capitalism's failing. I say, where the hell is it? Because I don't see it anymore. I really don't see it anymore, because there's a great line, and it comes from The Wire, and it speaks back to our conversation about financialization. And it's Frank Sabatka season 2. And he says, you know what the problem is, Brucey? We used to make shit in this country. We used to build things. Now we just reach into one another's pocket. There's your issue right there. And until that is resolved, I don't know what the solution is.
And to me, all these shenanigans about tariffs and things like that seem like they are kind of an effort to play whack-a-mole with a
Mhm.
Keynesian economy by going to a mercantilist economy, which
Right.
is that going to work? God, who knows?
Well, that's
Especially,
exactly, yeah.
when Fed chair is fighting with the president, who's fighting with the Treasury Secretary,
Yep.
and it's all a big mess and mired in politics. Although purportedly the Fed is not political, and of course Congress has incentives to continue to spend money that needs to have money be printed for it.
Yep.
But I want to switch gears now because
Sure.
honestly, all this feels like we're all these little fishing boats, and we're trying to stay. We're trying to catch fish in a hurricane,
Yep.
and it's gonna throw us out of our boats and into the sea, and then we're gonna have to start reaching for boards and flotsam and jetsam, right? But but before we do that, because we're not there yet, I don't think.
Mhm.
At least it doesn't feel like we are. We do want to start to think about things that we can hold on to when it hits the
Right.
proverbial fan, to mix metaphors. But first, I want to transition to more sort of a micro place,
Sure.
and you're willing to do that, notwithstanding this problem of how you find value in an economy like this because of the price distortions and everything. You've got um, you place some kind of emphasis on tracking insiders, corporate insiders,
Yes.
and so that gives you a little bit of sort of like local knowledge or more discrete knowledge that you might be able to find opportunity in where
Mhm.
other people might not be able to. What is a specific insider behavior that most retail traders ignore, but you consider a massive green light under your scheme?
Yeah. So there's a macro version of that, and then there's a micro version of it. So the macro version
Okay.
of it is you look specifically at the amount of money bought by executives compared to the amount that they sold, and it's known as the insider buying to selling ratio. When insiders buy, you got to keep in mind insiders can sell for any reason. And Peter Lynch once said the only reason they buy is because they believe the stock's going up. CEOs and CFOs, CFO buying is without a doubt one of the most important anomalies in all of finance, and it dates back to 1968 academically, and it has still never gone away. So CFO purchasing is very, very important. But the aggregate's important to me as well. When I look at that ratio over time, you could track it at secform4.com. And you look at this chart and you see that when insiders are loading up, and I mean loading up, they have collectively called the bottom of every major downturn since 2008. So massive insider buying in October of 2008 when Lehman Brothers collapsed. Then they load up in March 2009 when we started QE. Huge insider buying in 11, 15, 18, 20, and then most recently, sizable buying on November 20th, which coincidentally was the day before Japan announced $117 billion in stimulus and 2 weeks before the Fed announced $40 billion a month in treasury bill purchasing. So they do tend, what we look for is a spike in that ratio combined with a policy change that is accommodative. And it doesn't have to be called QE. It could be called a bank lending program for all I care. They can call it Steve. But it legitimately, those two things are very valuable. On the insider micro, it's really something that the strongest outside of CFO purchasing is known as cluster buying. And it's where multiple people at a company buy their own stock at the exact same time. And they do so within a 30-day window. And a good example of this, the one thing that I'm really looking for is purchases of companies that have some sort of choke point in the economy. There was recently, the ticker is UAMY, U.S. Antimony, and it's a company that effectively creates metals for ammunition here. And there's only two of them. And in late 2024, like 8 insiders bought for under $1. The stock ran to 18. And once again, these stocks, very high quality metrics, but also significant insider buying. And then this catalyst that comes from the Trump administration stating, we're going to buy 10% of your business or somewhere in that range. So that's very important to look for the companies where people are buying a lot of it and they either have some sort of monopoly in the US economy or some sort of choke point that everything has to go through them.
Now, and before you go any further than that,
Mhm,
let me just reflect back to you something that
mhm,
is intuitively strikes me anyway, and it seems like this goes back to your what you were telling us earlier about being an Austrian in a Keynesian world, right?
mhm,
We've got this tempestuous sea that we can't really make heads or tails of, but we can look at the behavior of CFOs, and what
mhm.
CFOs are doing is basically are doing we're mimicking the behavior of those who are participating in the Cantillon effect. Is that
Mhm.
kind of what's going on?
In some capacity, because they're gonna understand lending cycles, and they're gonna have
Yeah.
access to, finance, and that's certainly, a good hypothesis, and I would say that it does certainly reflect that, but it doesn't always have to be that. It can just simply be that the markets overreacted to an earnings report, and the CFO said, "I'm buying this stock for 25," and historically, we have seen, CFO purchases historically outperform CEO purchases and the broader market in general. Again, going back to multiple studies from University of Michigan and a lot of other data from University of Chicago going back to 1968.
But it's still not it's not pure value investing. Looking at a good old company who has a bright future and investing in it in that way, right? It's that could be part of it, but it's probably distinct in a lot of ways.
Well, there are other tools that you can utilize for the purposes of identifying what's known as quality, value, and momentum. Wes Gray has written incredible books about quantitative value and quantitative momentum, and really the approach there is to focus on some relatively simple metrics. It could be something as simple as having a low enterprise value to the earnings before interest and tax, which is an old school value metric. You can also do something like the Piotrowski F score, which is a 9 point balance sheet analysis of whether or not executives are doing everything that they should be doing on behalf of the investor, reducing debt, buying back stock, improving the return on assets. Those things matter. So if you combine, a situation where the CFO is purchasing it and they have these very strong metrics that show very little debt, very strong, improvement in operating efficiency, that's one more tool to help you build conviction to take action and purchase an equity.
And yet, I guess, I can't imagine someone like me, or probably a good portion of our listeners, finding the time to get to that
Sure.
level of granularity, that level of research. We want to be able to count on these index funds. We want to be able to count on
Right.
these ETFs because we want to outsource the job of finding quality in the market to someone else. And it's not clear that that always happens. My kids ask me what I do for work, and I say, I write, talk into a microphone, and hope people send money. Now I'm questioning my life choices, but the kids gotta eat, and we have bureaucracies to topple. Support our work at underthrow.org, and for less than $5 a month, you'll help me rouse the rabble. Wait, what's underthrow? If overthrow is violent, underthrow is peaceful yet powerful. Real change doesn't start in Washington. Casting your vote with millions is like crying a teardrop into the ocean. Instead, we build consent-based communities that make traditional power structures obsolete. Left, right, or center, it doesn't matter. What matters is creating options for opting out and opting in. We build parallel systems in which people thrive, then just leave the old systems behind. It's about choosing communities, not imposing them. So, support the show, feed my kids, read the newsletter, and discover why most subversive acts amount to building a better civilization together. Visit underthrow.org.
Let's just shift gear a little bit just to go back to a statement that you made about the
Yeah.
Austrian in the Keynesian world. I think for anyone who has that understanding, I think what you're seeing in the last year and a half was a dramatic shift in how we perceive money and a dramatic shift in how central banks globally look at the US dollar. So after we weaponized the Russian reserves and basically canceled their reserves, what is known as weaponization of the dollar, and all these other nations said, wait a minute, if they can cancel Russia's reserves, they can do the same to us. So we've seen levels of buying of gold that we haven't seen since pre-1971, before we came off the gold standard. And it has created, I think, this feeling for people that we are falling down a flight of steps and we're trying to grab onto something and there's nothing there. Like, people know something is off about this. And it could be the dollar system is cracking. It could be the split of the world that's happening right now. It seems like the United States is going to take the Western Hemisphere and China's going to take the Eastern Hemisphere, which is basically what happened 1500s, 1600s between Spain and Portugal. The question is, like, what do you do with your money? And if you're an Austrian, what I started to do in the last 4 months is I could sense something's wrong, but I also want to focus on what's real. What's something that I can dig my fingers into the dirt and know that this is an asset that is something that I need. So what I started to do, I started to look historically at what other wealthy families did, what wealthy families did during crisis in other historical periods. I went back to
Wow.
Judea, when, 60 AD with the Second Temple falls, go back to the time of Caesar, look at the time of France, look at the breakdowns of what happens in the French Revolution, look at what happened during the Long Depression here in the United States. And I'm
Weimar.
telling you what's so fascinating about it. They all own the same damn things. It's gold, it's silver, it's toll booths. So what they're doing, like, they own the roads. The wealthy families own the roads in periods of Rome. They own anything that had to move from one place to another. They were focusing on movement. They were focusing on the oldest form of extraction there is, which is taxing movement. So what are those modern choke points in today's economy? Well, land is, there's not more land coming. With for example, Prologis, which is a company that is a REIT, they do last mile delivery locations. There's not enough land outside of all of these major cities. Who do they charge for rent? Amazon, right? So money that's moving, pipelines, digital infrastructure, things that are tied to electricity generation. This is all what sovereign wealth funds own. This is what Norway's sovereign wealth fund owns. It's what Abu Dhabi's. They all own the exact same thing that these wealthy families owned over 2,000 years. They have international exposure. They're looking at countries that have strong economic freedom and resources. So Switzerland, Canada, Australia, I do work in Finland, Scandinavia. Like, these are resource-rich, finite land, finite assets, and I think that, like, that's honestly, I think in the post-2022 world, I think that is a very intelligent place to have maybe 20 to 35% of your assets tied up there, and then you focus on places that are going to continue to kick off cash, because that's what you're really going to need at the end of the day. The good news is your house is still priced in dollars. So even if they deflate, if they inflate the dollar and we see a continued
My mortgage will be
debasement,
cheaper.
your mortgage is going to be cheaper, right? So you want to own
Yeah.
assets that are going to continue to appreciate. And again, that goes down to finite assets that have real importance to the economy, particularly the choke points of the economy.
That is such a beautiful thing, and the penny just dropped for me. No pun intended there. There is a a thinker whom I've befriended over the years named Adrian Bijan.
Mhm.
He has this theory. He's an engineer, but he has developed a theory of physics called the constructal law. And the idea is that if there's any force that acts on a system from without, like from the outside, and impinges on it, the system has to evolve in such a way to create channelization, right?
Yes.
And so when you look around the world, all around the world. It doesn't matter at every sphere and scale, you can
Mhm.
find this vascularization, this channelization. You can look at river basins. You can look at the shape of trees. You can look at the way
Mhm.
your there are, arteries and veins in your eyes and in your body. Your brain is configured that way. On and on and on. Cities look that way from above. You know,
Mhm.
they have these arterials. They even call them that, right? So it strikes me that this mode of investment that you're sort of saying that you've turned to, and what apparently the rich folks of the past did during these troubled times, is to look at how we invest in the way things move while it's extractive,
Mhm.
and as long as it's not too extractive,
Right.
right? So it's like
Right.
a credit card company wouldn't want to raise its fees from 3% to 30% because people would just stop using credit cards, and I'm not sure that that's not altogether a bad thing, but in any case,
Right.
debit cards and so on. Um, so, you know, um, credit cards are other means of moving wealth, other means of moving, digital packets, other means of
Right.
this movement phenomenon seems to really track with this idea of the constructal law. Okay, geek moment over. Thank you for indulging me.
But it no, but
But it
it's
does
it yeah, it just speaks to, again, we go back to the concept of sovereign wealth funds and what they do. And when Trump became president, what we talked about, the lack of demand for US debt, but what are sovereign funds investing in? They're investing in our infrastructure. They're investing in our movement. They're investing in our pipelines and our digital, digital AI infrastructure. Hard claims on those assets, not a currency. So I think that that's another clue that the importance of the physical nature of an asset is it going to be much more important in the future. And it all stems back, I firmly believe, to the Russian war, but also, to the need for demand in euros. And it's very, I don't know if it's, what's the term I'm looking for, it does have a mercantilistic element to it, and mercantilism was the third thing that you brought up. I wanted to bring it up when talking about socialism and feudalism in the U.S., but it speaks once again to where's the capital moving, and it's moving at a time where this issue with silver, the financialization is completely broken down in silver. So now these physical assets are increasingly in demand. And I keep telling people, where do you think it's going to move next? It's going to the next metal. It's going to go to zinc. It's going to go to
uh,
all, because we need this stuff.
shockingly, I had a bee in my bonnet about 6 months ago, and I started investing in silver stuff, right?
Hmm.
And like look, I've told you from the outset, I'm not a wealthy guy, but I want to be prepared, and I want to make
Right.
little investments that branch out from crypto because I'm crypto crazy.
Hmm.
I'm not a Bitcoin maxi, but I'm a Bitcoin mostly. And but I do know, that there is something to this idea of precious metals. They're less volatile. You can hold them in your hand and so on. So, I'm not completely again that. However, I started, but I didn't buy like specific bars of silver, which you can
Sure.
do. Money Metals and all these companies out there that allow you to just, pick up some I think that's one, or Kitco. You can just get on
Hmm.
there and buy. You can buy stuff and they'll send it to your house and you can put it in a safe, right?
Yep.
Instead, what I did was like, okay, I think there's going to be a lot of investment in silver because it's sort of like the B team behind gold, and gold is already really up there. So where are people going to look next? They're going to look at other metals. So I was like, okay, let's see about silver and copper. And so I put some money into companies that mine silver, companies that deal with silver, and so on. Is that a mistake, or what you're talking about really not having paper metals, or paper representations of metals like securities? Is it that you really need to have some
Oh,
in your safe?
I think it's a very credible form of diversification to have access to metals and to have access to something that is transferable. Now, I don't know what the world would look like where I'm trying to exchange $80 silver coin that's actually says $20 on it with the U.S. Mint on it. I'm not convinced that we're going to be able to understand, because the bulk of Americans are still not invested in gold and silver. It's still an extraordinarily low figure, but I do think it's important. I own physical gold and I own silver, and I have a safe deposit box, and I wanted to start burying it around Baltimore County, Maryland. But the reality is, like, there is a sense of behavioral comfort to owning it. And that's an important thing, because there are other things that I own. The PHYS is the Sprott Physical Trust for gold. There is SLVR, which is the Silver Trust. And why I like those things is because every single share is a claim on actual silver. There's no worrying about margins with miners, and I have no problem with miners. Miners have done great, but I'm not investing in the paper markets. I'm not touching the futures market. So I have a
Gotcha.
claim on silver that is up in where Alberta, Canada, that's owned under bought under lock and key. But am I ever going
I
to
know
see it?
people are stopping this
Right?
right now. They're stopping this video
Yeah.
right now,
Right.
writing this stuff down, sending themselves emails.
I think it is important to have physical. And again, I don't know what people keep saying, like, when is this going to break down? When could this all fall apart? And I keep arguing this can go on a lot longer. This could go on another 15, 20 years. It'll be interesting to see what happens when we see the cracks in the Social Security system and Medicare start in the first half of next decade. But you know, financial regimes can persist, and they will continue to get more creative. And again, I think that silver is a very useful mechanism. It's not just the wealth protection element, but also, like, none of this AI stuff, EVs, missiles, all that technology. It is a heavy in demand industrial metal. And then the next question is, where does the speculation move next? People are looking under rocks, and they're paying attention to zinc and graphite and all these other metals. And Peter Zeihan had
Zion,
made
yeah,
it.
mhm.
Yeah, he made a great observation maybe 3-4 years ago, where he said all these mandates on EV, all this electrification. There's 16 metals that we need, 16 metals, and we have to increase the production of all of these metals by a factor of at least four. Lithium, I think, is 10x, and I want to say the top one was graphene at like 16x. We have to increase all of them by these wild numbers over the next decade. And then he pointed out we've never doubled the capacity of mining production on any single commodity in 10 years ever. So those shortages are going to persist. Those demands are
Yeah,
going to continue to persist. And the real
and
question
that's gonna
now
attract
becomes,
capital.
yep, and China's shutting down exports on a lot of this stuff, because they view it as strategically important, because I think at the end of the day, the Cold War of AI is only going to continue to grow more intensive, and they want to win that battle against the United States. So they're going to hoard their resources. And it's important to note that China has been doing this. They've been hoarding resources like they've been going to war since 2004.
Yeah, and buying gold.
Yeah, gold and silver and soybeans, just soybeans. So this bifurcated world, if that continues to accelerate, these assets are going to continue to move, and then we're going to continue to see, what the world looks like in 5 to 10 years. I think it's going to be a lot different than what people remember, and it's going to be good for metals owners. I don't see silver going back to 40. I just don't.
Yeah. Well, and the other some of the other metals that may be underappreciated for the reason by virtue of just being a precious metal, but
Right.
still you have a situation where, going back to your point about if it moves, invest in it, right? Because that's what
Right.
the rich folks did when things started to collapse. You've got metals that move because they're conductive, right?
Right.
And really, especially if all the rare earths and things like that, China continues to corner those markets, and we're not, and Trump doesn't go in and claim Greenland, which is probably a huge reason, I suspect, why that's happening is because of these, because of the strategic interest in all of these, in all these rare earths. We're going to have to figure out a way to do electronics and all of this stuff, particularly with AI, the super bubble of AI, we're going to have to figure out how to build those components, and that requires conductive materials and so on. I think I'm getting it. I'm feeling like an investor, but
Mhm.
but let me ask you this before we move on to our final segment. You know, there's still a level. Do we still have time just to do something simple like buy the dip?
Well, once again, if you're trying to buy the dip in metals or in are you talking about metals or are you talking about just the stock market in general?
I think both. Let's take them in
Okay.
turn. Let's
So
keep with first with the metals and then go to the stock market in general.
yeah, I think the general situation right now with silver, a lot of this is playing into the ongoing pressure that has come from CME and the London markets, and there is speculation that I want to say on the next major expiration for silver is March 27th, which means physical deliveries have to be done on March 30th. Um, they don't have enough metal. I think
Mhm.
the total number of contracts is somewhere between like 1.7 times the amount of metal that they have in delivery now or for delivery. But most people are not people who are speculating on futures contracts or trading some of these ETFs that are linked. They are not ever going to take physical delivery of silver. You're not showing up to the CME in Chicago, which is that bar behind me. That's in the CME series. Um, the thing is, it's just not going to. Yeah. So it's a big risk to try to make the assumption that so many people are going to try to step back in. But the export controls issue are very clear. I would say that if you're going to be trying to buy any dip on something, you have to be very patient. And if you're new to trading or you're new to what's known as momentum, I can just give you a very simple rule. Focus on the 20-day moving average. When it's above the 20-day moving average, trade it. And if it drops under the 20-day, let it go. Just make sure that the 20-day moving average is ascending, not descending, right? So you're buying into momentum. You might want to buy the dip at the 100-day moving average. That's historically a very good place to purchase equities and purchase some of these materials. And just make sure that when you look at a line of moving averages on a chart, that they are going up when you're buying the dip, not when they're going down, because what can occur is you're moving into a cycle of lower highs and lower lows. So very important to follow momentum up, but recognize that momentum eventually rolls back over. On the markets, I go back to the same argument that I had. We have a signal that we use to determine when the markets are under pressure, particularly liquidity events. It is a basic thing that you can do at home. This is not the full math behind it, but the poor man's version of this is pretty simple. Take the number of stocks that are up 5% on a week, up on the month, and have a beta between 1 and 2. And then subtract the number of stocks that are down 5%, down on the month, down on the week 5%, down on the month, just down on the month, and a beta of 1 to 2. If you have a positive figure, money's flowing into the market. If you have a negative figure, it ain't. And you want to look at something that's known as the FNGD. I'm not going to go too deep into that, but when that is breaking its 20 and its 50 moving average, that's a bad time for the market. That's leverage leaving the system. That's the FANG stock selling off. Okay, so now you have a situation where you have a negative answer to your equation. FANG stocks, the big S&P 500 stocks are selling off. What do you do at that point? Watch what the insiders do and listen for policy clues. If the Federal Reserve announces that they're going to be doing new quantitative easing, it's bullish. It's more capital moving into equity markets. If they announce a new lending program and call it something completely different, it's still money moving into the financial system and improving liquidity events. I stress this. I don't believe that the purpose of the Federal Reserve anymore is to manage inflation and manage the labor markets. I think it is to provide stability to global markets at all given times. And we have seen it time and time again. And finally, in the last couple of months, they have been increasingly transparent about it, where they warned about repo markets, where they said that what they needed to do, where Logan in Dallas said we have to provide capital to prevent a crash in repos in the repo system. Listen to these terms, familiarize yourself with them. And then when you hear anything that sounds beneficial and insiders, executives are buying hand over fist their stock, there's your dip. There's your opportunity for the next cycle.
The
Sure.
50-year mortgage. Smart or stupid?
Absolutely stupid. And so is buying MBS. They just announced that they're going to buy $200 billion of mortgage-backed securities. The reality is, what is the number one reason? And I learned this from time advising one of the big government-sponsored enterprises. What's the primary driver of housing prices over the last 30 years? A lot of economists will tell you it's the 30-year mortgage, because it creates demand. And when you have, you're lowering the payment by spacing it out over a duration of 3 decades. It's a great innovation to spur economic activity in buying and housing, but it also leads to speculation. It leads to speculation in those assets. So the idea of a 50-year mortgage. First off, most people, the only beneficiary, it really seems to be the banks, right?
Thanks. It's
Yeah,
like, you're
which
not
is
really an
kinda how it
owner,
works.
you're just
Right.
becoming a
You're
50-year
renting.
you're renting, yeah. Okay.
So there's that and MBS. So both of those things will that would only drive up housing more. And it's funny that they came out and did this, made that recommendation, given the fact that Kamala Harris had pushed for 40 years. And it was like, hold my beer. We're going to go to 50. At that point, a little crazy. Other nations do, I think, 100. But, I don't see the actual value in it. Where you really need to focus to get housing prices down is in labor, lumber, land. You gotta reduce zoning. It's a supply
Yep.
side issue. There are 25,000 regulatory bodies in the United States that oversee housing zoning.
Somebody tell Zoran Mundani. I mean, even Paul Krugman agrees with you on this, shockingly.
Right.
So, okay,
Oh, we
another
left we
one.
left out communism too. We forgot that communism's in America too.
Yeah, it's like, it's back, everybody.
Right.
We forgot about, the Berlin Wall falling and all the other crap that came before it. Never mind
Yeah.
the 50 million dead in China and the
Right.
40 million dead in Ukraine. But
Ugh.
seriously, though, oh gosh,
And
I'm
yeah,
cracking
one
myself up because it's so dark.
well, one of the things that I always encourage people is, you hear these news, you hear these headlines. I try my best not to infuse any political commentary into the writing that I do. I just tell people to
Mm,
try to control what they can control. You can control your health, you can control your wealth, and you can control yourself, and get those 3 things in order first, and then go out and affect change, because like I see too many people worrying about things they can't control, and it breaks them.
yeah, yeah. I almost want to end on that because that's such a good lesson to stop on.
Mhm.
But I'm too tempted by 2 more questions.
Sure.
One is smart or stupid, preventing Blackstone from buying residential properties.
You know, it's one of those things where there is a benefit to it, and then there is uh, a deep psychological problem for the financial markets. Um, they provide liquidity, they provide capital to the markets. They're buying assets and they're improving them. And it's not as big of a figure as I think. I think it's 2% of housing is managed by these large real estate groups. I will tell you that I had Blackstone as my landlord for a short period of time when I moved to Maryland. And they were fine, but nonetheless, their investment in that property probably drove up some of the housing that was around me. Because they're providing an injection of capital. The downside, I think, is the continued psychological impact of it. And there's a couple of things that are really important. BlackRock and Blackstone, right? Blackstone is a private equity company. BlackRock is the largest asset manager in the world. They ran out of things to buy. They like bought every single big public company up until their caps. So if you go into a grocery store and you see all of the salad dressing, all the salad dressings made by 4 companies, and BlackRock and Apollo own all of them. Like so they have a dramatic impact because they have the voting rights, so many voting rights in the equity markets. And the question really then becomes, should they have voting rights in policy, in housing policy? Because a company like that is not going to be interested in zoning laws. They're not going to be interested in more supply because they are thinking of the asset only as a financial asset that they want to appreciate on behalf of their shareholders. It's not that I have a problem with it, but I do know that Mondami certainly does. I do know that policymakers certainly do, and it becomes this massive distraction and this massive highlighting of one of the major issues that continues to transpire. And I just continue to stress, they're not going back far enough to solve the problem, because the problem is not necessarily that Blackstone is buying the assets. It's that Blackstone is getting access to capital before everybody else, and then buying, and then right. It starts
It's
back
almost
here.
always politicians treating the symptoms for a pathology that they caused sometime in the past.
Or they don't understand it. They don't understand how the repo markets work, how rehypothecation of debt works. Like I'm using these big terms. I watched somebody on the selecting committee for finance interview somebody from the Federal Reserve about asset prices, and I don't think either of them knew what they were talking about. And like that's where we were. So there needs to be a deeper understanding of how that system works. And I remember I was asked by a producer if I would be interested in going on a major U.S. network and doing a 10 to 15 minute segment on the Fed. And I said, I still think the Fed has an area of necessity to it, but I said, if we were to tell the story that I know, I worry that people would march upon the Eccles building and try to burn it down.
The world speaks in riddles, markets, politics, power, the very nature of consciousness itself. But what if there were guides, a secret fellowship dedicated to reading the signs, to building bridges between the seen and the unseen? The gray robes operate in the space others fear or cannot comprehend. We map the territory between spiritual awakening and practical revolution, between ancient wisdom and radical innovation. 12 dimensions guide us. One mission impels us. Find out more at grayrobes.org. That's grayrobes.org. Let's imagine that after some big collapse, the people came groveling to you, probably because they found all the other masters of the universe and ran them out of town, right?
Yeah.
But they said, they say to you, Garrett, we want you to either run the Fed or dismantle it.
Mm-hmm.
And if you're going to do so, one or the other, how are you going to do it?
Wow, that's a tough question. Well, first off, I would say you don't actually eliminate the Fed. What you have to do is you have to break it into a million pieces into, really 4, right? You need to break that up into the functions that it should have had all along in the banking system. And what I mean by that is you have to have a lender of last resort. There has to be something in place. So that backstops the payment system. It provides emergency liquidity to solvent institutions. There's no permanent QE. There's no credit allocation. We're not managing
wanting to
stocks.
Get rid of fractional reserve.
Well, fractional reserve is a whole other animal that would take us an hour to dig into. And the funny thing about fractional reserve is the fractional reserve, it's still at 0%. Like we never raised the reserve requirement back up after COVID, which is creating even more issues. I would say you need to have a very transparent framework, and it could be the Taylor rule, which I'm not a huge fan of, or some sort of nominal GDP targeting, or some sort of money supply focus that I think the markets would adapt a lot better to a known rule book than kind of you have a rules-based monetary policy. It's not vibes, it's not improvisation, and that's really been the problem. It's been a significant amount of improvisation when it comes to it. Then you have to create an independent financial stability authority. And, that's somebody who is in charge of enforcing debt sustainability rules and actually forces Congress to live within their specific means. Because that's the problem. The problem at the end of the day is the deficit. So right now the Fed's doing a lot of this work by accident, which is completely and totally insane. And I think the other major thing is that the Fed is going to have to force, and I mean this in like the worst way, they may have to force M&A activity in the banking sector. And what that means is you need to create conditions in place where a lot of smaller banks can get bought up. And, we have a lot of too big to fail banks, but we also have 150 banks trading for less than the sum of their parts. Tangible book value is the term. Literally, like these banks are worth less than the sum of their parts, and it's because of regulatory oversight from 2012. And I would actually move banks or supervision away from the Federal Reserve. Like it just reduces conflict of interest, and it would force real
Corruption.
economy. So it's not to kill the Fed; it's to shrink it, it's to focus it, stop it, from asking one institution to run the entire economy. I don't know who would share that additional responsibility at the moment because I was not prepared for this question. It speaks to a bigger issue. I think that you asked me, and I would say you're probably one of 6% in America. I think that was the last survey. Only 6% of Americans have a knowledge of what the dual mandate is for the Fed. And only 1%, I would bet, actually knows that financial stability has really been prioritized over all of these other things. And if
So the
that's
dual
the
mandate
case,
no longer holds, really.
but the fact that most people can't even name that the dual mandate means that people don't actually have a deep understanding of Federal Reserve policy. And I'll say this once and I'll say it 100 times. Those 12 people who gather in the room for the FOMC meeting have more control over your life than any president ever could. And nobody can name any of them, maybe outside of Jerome Powell. So
And on that note, I wish we could go another hour talking about problem
we'll
of
do it again.
inequality, all of this stuff, that is people just don't understand that this reemergence of the specter of socialism really is rooted in so many of these problems and distortions that have to do with the Fed and frankly Congress hitting the gas when there's only fumes. But Garrett Baldwin, you've given all of our listeners value that people would be willing to pay you $500 an hour for. So, sir, thank you very much.
Absolutely. Thank you for having me. And yeah, I'd love to come back and have another discussion. And we're going to launch a podcast relatively soon for a money printer. So I'd love to have you on as well.
Yes. Awesome. Awesome. Well, to the extent that anybody wants to hear from a damn philosopher when they're trying to pad their retirement, well, I'll be happy to do it. Thanks again, Garrett. And you take it easy.
Thank you so much.